Good day and welcome to the Navin Flourine International Limited Q2 and H1FY25 earnings conference call. As a reminder, all participant lines will be in the listen-only mode and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing the star then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Bhavya Shah from Orient Capital. Thank you and over to you, sir.
Thank you, Steve. Welcome to the Q2 and H1 FY25 earnings conference call. Today on this call, we have with us Mr. Vishad Mafatlal, Chairman, Mr. Nitin Kulkarni, Managing Director, and Mr. Anish Ganatra, Chief Financial Officer of Navin Flourine International Limited. This conference call may contain forward-looking statements about the company, which are based on beliefs, opinions, and expectations as of today. Actual results may differ materially. These statements are not the guarantees of future performance and involve risks and uncertainties that are difficult to predict. A detailed safe harbor statement is given on page number 2 of investor presentation of the company, which has been uploaded on the stock exchange and company website. With this, I now hand over the call to Mr. Vishad Mafatlal for his opening remarks. Over to you, sir.
Ladies and gentlemen, I would like to welcome you all to Q2 and H1 FY25 earnings call. I am joined by our MD Nitin Kulkarni, our CFO Anish Bhai, and Payal from Orient Capital, our investor relations advisor. I hope everyone got an opportunity to go through our financial results and investor presentation, which have been uploaded on the stock exchange as well as our company's website. I am pleased to begin by announcing that the board has decided to declare an interim dividend of rupees 5 per share. At Navin Flourine, we are committed to operating sustainably and responsibly. This commitment is reflected in our corporate culture and strategic approach. In the last quarter, we released the second edition of Navin Flourine Sustainability Report, where we continue our journey towards sustainable excellence. Building upon the foundation laid in our inaugural report, we are proud to present our progress, achievements, and ongoing initiatives in advancing sustainability across our operations. I would request all of you to refer to our sustainability report uploaded on our website. As we move forward, I want to take this opportunity to share a broader perspective on our strategic direction. As we have mentioned, we remain committed to operational excellence, and this does not only mean optimizing our processes, but also embracing innovation, enhancing productivity, and ensuring that every facet of our operations remains efficient and resilient. In line with our commitment, we have focused on maintaining disciplined execution with highest standards of safety, compliance, reliability, and efficiency. Additionally, we continue to focus on strengthening partnerships and building scalable platforms. Both Nitin and I have met our key customers across geographies in the last few months, and we will continue the engagement to deepen our partnerships. Collaboration is key to unlocking new growth opportunities, and by nurturing these relationships, we aim to create long-term value for all our stakeholders. In addition to this, a robust financial framework underpins our growth. Our net debt to equity remains below our guidance range of 0.5x. In the last few quarters, we have made efforts in optimizing the working capital cycle, ensuring robust operating cash flows. We remain focused on maintaining financial discipline, ensuring that our resources are allocated strategically, aligned with our long-term vision. We are confident about the future and the opportunities it holds. Thank you once again for your continued support. With that, let me hand over to Nitin to share our operating and business performance during the quarter.
Thank you, Vishad Bhai. And good evening, everyone, and thank you for joining us the earnings call. We appreciate your time and continued support. I want to start by recognizing that our relationships with strategic partners are growing stronger and deeper, reflecting the collaborative approach we have developed over time. As we navigate the evolving market landscape, our key priorities remain clear: maximizing capacity utilization, improving productivity, and driving efficiencies across businesses. These priorities will guide us as we commission new projects and develop future growth opportunities. Now let me walk you through the performance of our key business verticals, starting with our high performance product, that is HPP business. During the second quarter of FY25, the HPP business achieved 23% growth, with revenue increasing from rupees 238 crore in quarter 2 FY24 to rupees 293 crore in quarter 2 FY25. In the last quarter, all HPP assets continue to operate at optimal level. The growth is mainly attributed to higher R32 sales and better realization for R22. Additionally, the expansion of R32 capacity with a capex of rupees 84 crore is proceeding as scheduled and is expected to be completed by February 2025. Our interactions with existing and new customers giving us confidence on offtake of the upcoming capacities as these are operational. Our AHF project, which involves an investment of rupees 450 crore, is on track, and we anticipate commissioning by the end of FY 2025 or early FY 26. As we move forward to specialty chemical business, we experienced a decline in revenue for this business with a degrowth of 15% from rupees 185 crore in quarter 2 FY 24 to rupees 158 crore in quarter 2 FY 25. Sales in this sector were affected by the current global situation, leading to cautious demand behavior amid continued competitive pressure being witnessed globally. Our strong customer relationship and strategy to drive value for our customers has started to show positive results as we speak. There is a strong visibility to order pipeline for Dahej and Surat assets that will drive improved capacity utilization and growth from Q3 onwards. We are continuing to make progress in product innovation within this vertical too. Recently, we introduced a new molecule at our Surat facility, and we are on track to launch 2 additional molecules in the upcoming quarter. On the capital expenditure front, our upcoming agro specialty plant at Dahej, with a planned capex of rupees 540 crores, is under commissioning jointly with our customer to ensure a safe and efficient startup and commence commercial production by November 24. Simultaneously, our Surat project, with an outlay of rupees 30 crore, is commissioned, and the first dispatch will be in November 2024. Moving into the CDMO business, CDMO revenue has increased from rupees 48 crore in quarter 2 FY24 to rupees 68 crore in quarter 2 FY25, reflecting a growth of 41% year on year. We have a strong order visibility with firm orders for the second half of FY25. Additionally, our strategic focus on late stage and commercial molecules continues to yield positive results, with the business continuing to witness higher levels of customer inquiries than previously. We are encouraged by the traction with our European CDMO partners and the deepening of our relationship with them. Customer projections are strong for FY26. We are additionally secured order for 2 new late-stage intermediates which are scheduled for supply in Q4 of this year. Furthermore, we continue to make progress with our EU major and US major clients. For the EU major client, we have supplied quantity for process performance qualification for late-stage study, and for our US major client, we have received scale-up order for supplies in Q3 FY25. On the capital expenditure side, our CGMP4 project is advancing well. Phase 1, involving an outlay of rupees 160 crore, is progressing as planned, and we aim to have it commissioned by end of Q3 FY26. So in conclusion, our strategic initiatives combined with continued investment in capacity expansion and product innovation position us well to drive sustainable growth across all our business verticals. Thanks for your continued trust and support. We look forward to sharing more updates on our progress in coming quarters. Now I would like to hand over Anish to brief you on financial performance. Over to you, Anish.
Thank you, Nitin. Good evening all, and I welcome you all once again to the earnings call. Moving on to the financial performance of the company in Q2 and H1 FY25. Quarterly performance. We reported revenues of 519 crores in Q2 FY25, an increase of 10% year-on-year, led by an increase in revenue from our HPP and CDMO businesses. Operating EBITDA for Q2 FY25 was approximately 107 crores, an increase of 9% year-on-year. Operating EBITDA margin stood at 20.7% as against 20.8% in Q2 of FY24 and improving sequentially from 19.2% in Q1 of FY25, reflecting higher realizations in HPP as also benefits from efficiencies secured within the businesses. Profit after tax in Q2 FY25 stood at 58.8 crores as against 60.6 crores in Q2 FY24 and 51.2 crores in Q1 of FY25. Half-yearly performance. For H1 FY25 on a consolidated basis, the company reported net operating revenue of 1,042 crores as against rupees 963 crores in H1 FY24, reflecting a growth of 8%. Operating EBITDA stood at 208 crores as against rupees 213 crores in H1 FY24, down by 2%. Operating EBITDA margin for H1 stood at 19.9% as against 22.1% in the same period last year. Profit after tax in H1 FY25 stood at 110 crores as against 122.1 crore in H1 FY24, a decrease of 10%. We continue to ensure a tight financial framework while driving growth. As of 30th September, our net debt to equity stands at 0.39, well within our guidance range of 0.5, and reflects the strength of our balance sheet. Operating net working capital days at the end of 30th September is approximately 104 days of sales. That's all from my side. We can now open up the lines for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handset while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. The first question is from the line of Vivek Rajmani from Morgan Stanley. Please go ahead.
Hi, sir. Thank you so much for the presentation. Two questions from me. Firstly, on the specialty chemicals, just wanted to understand, what gives us the confidence of the visibility or the improved visibility for the second half, given that, we have seen some deferrals in the past. So could you just give some color in terms of what's changed in terms of the conversations that you're having with your customers?
So, to give you the feedback, these are, the firm numbers because we have entered, into the supply understanding, for most of, the spec molecules, which we are talking, for the not only Q3, Q4, but, for the calendar year 2025. So, based on, our existing capacities, we manage, to speak and, enter into the understanding with the customers, and that has helped us, to address, our 3 products, which are, one of the, I will say high volume, high value products to enter into, the supplies including, quarter 3, quarter 4, the balance of, the calendar 2025. So what we are talking over here is not, any assumptions, but based on, the firm orders which we have received.
Sure, sir. And just a clarification on this. In terms of these orders, are these multi-year orders, or because you're saying you have the visibility even in calendar 25, correct?
Correct. So, there is a basket of products where, we have received, the visibility along with, the POs till calendar year 2025. And based on that, we are, giving the feedback to you.
Just to add, I'm just complementing what Nitin said there, Vivek. If you look at what Nitin mentioned, it's covering not only Surat assets but also the Dahej assets. We talk of the MPP and the dedicated agro plant. We have line of visibility to their full order book, not just for the remainder of this year, but going into next year.
Sure, sir. That's great to hear. And the second question was on CDMO. I know it's difficult to, give a clear number over here, but given that, you're making traction with, both your European client and the US client, and obviously you have some 2 new molecules, could you just give us a sense of what is the trajectory we should expect for the second half of this year, as well as, going into, fiscal 26, in terms of how these will ramp up?
So again, on the CDMO front, Vivek, the order book is again based on the discussions that Nitin and Vishad Bhai have had with the customer. And again, we should look to at least a like-for-like Q3, but a very strong Q4 and going forward even stronger.
Sure, so that's super helpful. I'll rejoin the queue. Thank you so much and all the very best.
Thank you. The next question is from the line of Sanjesh Jain from ICICI Securities. Please go ahead.
Yeah, hi. Good evening. Thanks for taking my question. I got 3 questions from all the 3 segments. First, on the CDMO, if I remove the domestic, which I believe is a supply for the European client, the rest of the business doesn't look very exciting at under 30 crores of revenue. What's happening on that initial stage? Has that completely been defocused? How are we looking at that part of the business? Connected question is that now we have multiple order book, 1 to the supply European client, 2 late stage product to be supplied in Q3, Q4, 1 scale-up project for an US client. So it appears to be jumbled up. Do we have capacity to meet all these orders requirement on time? So that's on the CDMO. On the specialty, domestic suddenly has shown a sharp improvement quarter on quarter. I thought we were defocusing the domestic pharma part of business and largely focusing on the agrochemical and the fine side of the business. What has driven this domestic revenue growth in the specialty part of it? And the third question on HPP, Nitin, I guess you mentioned in your opening remark that we have reached optimal capacity. Is it fair to assume that until the new capacity on R22 come, it's only pricing which will drive the incremental growth in the HPP?
So on Sanjesh, so thanks for your question, Sanjesh. On CDMO, again, your question about capacity and to look at whether we can meet the orders. I think again, we've signed the entire project of GMP4 coming in alongside considering what capacities are needed. 1. Second, on the orders other than the large CDMO, European CDMO, your question around the fact that, are you de-emphasizing early stage? So the answer to that is no, we're not de-emphasizing, but obviously the commercial molecules will start to occupy greater pie because their volume is large, right? I mean, that's the very nature. That's the precise reason why we are going into that business, right? And so it's not de-emphasizing, but it's balancing. And like we've always said, that you will see a proportion of 60% or coming from commercial going forward. But remember, the pie size grows bigger, not smaller. So that's what will come in over there. On the specialty side, the domestic revenue, some of it is very opportunistic. We saw an opportunity to do some of the old molecules that we were doing in the pharma, and we picked it up in the current market scenario. So that is there. Plus also we supply to local customers on behalf of large global players. So some of that also plays into the domestic pie. I wouldn't read over there any different message, because as Nitin has mentioned before, on the spec chem side, both Surat and Dahej, we are witnessing and we are seeing a very strong order book in hand in the Q3 and Q4.
Just to add to that, Sandesh, to be very frank with you, I failed to pick up, that how you arrived, that only domestic, sales has, given us the betterment, because basically most of the spec chem business, I think the major portion is for the exports, as well as the products which we supply in the domestic market. Those are also as a part of the supply chain. So there are couple of products so which are in the supply chain, which normally gets exported. So this is everything is triggered off more than 70% of the business into the agro space only, and that too also with the innovators. So pharma, there is a very small portion of this particular revenue, that too also of the one of the traditional molecule which customer requested us to restart the operations. So absolutely, as far as the spec chem business is concerned, the growth which we have observed in Q2, or whatever we have done, and what we are talking in Q3, Q4 and forward, is based on the existing global agrochemical customers which are already working with us and to whom we are giving these products. As far as your point of the R22 expansion concern, is it about 22 or 32?
30. I'm telling you,
Huh?
No, so your point. So Sandesh, please repeat your question if you don't mind.
Yeah.
The
HPP.
I said that we have optimized the capacity utilization on most of the product, is what Nitin said in his opening remark. That means until the new R32 capacity come in, it is only pricing which can drive the growth in that segment.
No. So new R32 is absolutely a new capacity that will come in. Also, as we mentioned before, remember on the HFO project, we've always said that what we are doing today is we've got the plant running to optimal capacity. That's still meeting about 80% of the demand. So there is growth over there too, right? So there is stuff happening on that front. Plus, even within the R32, there are options to build, which we are working on to debottleneck and get greater capacities. But that's still work in progress. But it will be pricing and volume growth.
Exactly. Plus, we are putting up this R32 capex, which you are already aware, which is going to come in the Q4 of the FY25. So based on the visibility, what we see with respect to volume and price, definitely this is going to drive the future growth.
Just one follow-up on all those answers. Anish, you said that CGMP4 will help us, but I was more asking from the second half of FY25. Now we have to deliver so many 4 products. Do we have capacity from CGMP?
No, so Sandesh, again, these products are campaign driven, so their quantities tend to be smaller. The commercial stage products that we talked about are actually study stage products. We clarified that even last time, right? Those are being worked. So those volumes will come in. There will be even more RFPs that we are receiving, as also Nitin mentioned in his commentaries. So there is work that will carry on, but there is no concern on the capacity and the growth. If you remember what we've done in Q4 of FY23, if I remember, that number is significantly high just with the current base. We are not really concerned on the capacity side there. Of course, our idea, because of the continuous growth in the business that you're looking for, you will have a CGMP4 that will largely, as we've talked at the site visit, phase one will get virtually dedicated to the European CDMO player. The other capacities will continue to fuel the growth for new pipeline coming in and, also phase two of CGMP4.
That's clear. Thanks, Nitin. Thanks, Anish Bhai, for answering all those.
Thanks, Sanjay.
Yeah, best of luck.
The next question is from the line of Madhav Marda from Fidelity. Please go ahead.
Hi, good evening. I have two questions. Firstly, on the specialty chemical business, when we see that we have strong visibility into second half of FY25, does that mean that if you compare to the last year of the second half, we are looking at year-over-year growth coming back for us? Because first half has been obviously impacted by the industry level challenges which everyone's facing.
No, yes, indeed. Remember, we shared our way and approach in the spec chem business, and particularly, both Nitin and Vishad have been very clear how we need to respond to the current market scenario, and that has started to play and show success. So I think you should expect to see a year-on-year growth coming through.
And this is what we are talking is based on, the POs and the firm orders which we have in hand.
Okay. So second half specialty chemical you're saying can grow over last year. Got it. Okay.
Yes.
And my second question was on the CDMO business. Given that we are addressing pipeline molecules of pharma customers, innovator customers, just a suggestion, could we start giving this in the presentation how many molecules we have in different phases like phase 1, phase 2, phase 3? And how many are in, process of registration, just as a disclosure, so it just becomes easier for us to track it every quarter.
Point taken. Yeah, point taken.
Yeah, so like total number of molecules that we are addressing and just the phase-wise spread.
So we don't see typically the number of molecules. I mean, we've shared a couple of key material ones. If you remember, Madhav, when we spoke, when we started sharing this, the idea was and the intent was to show how our strategy is working across the globe. Therefore, we shared the geographies and the most material molecules that we think today are potential molecules, right? There are several others we are working for, but each of these are different chemistry. We don't count or monitor the business in that sense, to look at the number of molecules in different stages, etc. Our bigger thing that we are focused on is ensuring that the pie grows and the proportion of the pie starts to look more like 60-40, 65-35, between the...
No, I understand that. I'm just saying that given that this is a CRAMS or a CDMO business for innovator pharma customers, that's how the peers disclose in India, if you look at some of the other names. So just helpful for us to maybe make a comparison. That's all.
We'll think about it, point taken, but that's not how we internally look at. But point taken.
Okay, yeah. Thank you much.
Thanks.
Thank you. The next question is from the line of Abhijit Akela from Kotak Securities. Please go ahead. Hello, Mr. Abhijit. Your line has been unmuted. Please go ahead with your question.
Yeah. Good evening. I hope I'm audible.
Yeah.
Okay. Thank you. So just one clarification first regarding the CDMO outlook for the second half. Anish Bhai, if I heard you correctly, based on the order book, we expect at least a flattish third quarter year over year, followed by a very strong fourth quarter, and then even stronger in FY26. I hope I got that correctly.
Yeah, I think that's a fair take, Abhijit.
Okay, got it. And both for CDMO for say fiscal 26 as well as specialty chemicals, given the kind of order visibility you have, would you be able to help us with some sort of percentage growth guidance for fiscal 26?
So we don't give guidance. I've given you directionally, but unfortunately I won't be able to give you guidance.
Okay. Then just on the 540 crore project, how much the timeline seems to have slipped a little bit. We're not talking about November. It does seem to have slipped since, it was previously envisaged, I think, for December last year. So what exactly is the issue there? Are there any technical problems or is it just market environment? And then how much revenue can we expect from it in fiscal 25, given that we only have 4 or 5 months now left to deliver?
So, this is Nitin. So, just to give you the, answer about the market or, the PO, absolutely, there is no problem. And we have, the existing, PO in hand, for, the customer, with whom we are doing this project. And they are also partnering with us, for the technology support. So this is one of the most complex and, the high-end technology. And there are multiple, touch points, to really bring it, to the optimization level and, to reach, to the process efficiency. So far, everything has progressed quite well. Of course, as you also know, during, the startups, the way we faced, problem, during Orchid time, similar type of, challenges which we are facing, which we have addressed, quite well. And everything is, now moving into the right direction. So there are, some, as you rightly said, delays, but those delays are not, where we are stuck somewhere or, we are clueless. Absolutely, we are bang on, as far as, the progress of, the, I will say, stabilization concerned. And as we said, that, November is the month, when you will see, that we have started, dispatching and producing, this product.
Got it, Nitinji. Just last question, if I may, before I get back in the queue. One is for the non-dedicated portion of that contract, which I presume you will start supplying commercially next year. Will the margin profile be, materially sort of more dilutive compared to the dedicated portion? What sort of margin profile should we work with?
So Abhijit, again, for the non-dedicated portion, when it comes in, we will have to remain competitive to the market, and whatever that is, we will remain competitive. I mean, I think the work that the team is doing here is absolutely focusing on making sure that the plant comes up efficiently and reliably. And part of the reason why the effort is being put on making sure that it comes in the right way is to ensure the reliability remains high, and therefore we are able to have, good norms, good yields, good outcomes, which will help us also to remain competitive. Yeah, it's true for all seasons, right? I mean, no matter what the market is, ultimately, if you're the last man standing, then you are likely to remain profitable no matter what. So that's our intent. Yeah, absolutely.
Okay, so got it. The Surat 30 crore capex, what would the revenue potential from that be? Just that's the last thing from me.
One second, we will answer.
Okay, so the peak revenue is about 50 odd crores. We'll start with the campaigns in this year from the product, and it's starting in this quarter itself actually, and we'll slowly ramp it up over the next sort of 1.5 year or so.
Just to add to what Anish said, so this already project commission, we have started, the operation, and from next month, you will find, the deliveries. And for this particular capex and the product, we again, my other comments, we got, the firm PO in hand, for the next year, complete.
Also, Abhijit, remember, this is not a dedicated plant, so it's an extra capability we've introduced in Surat. So how we optimize and run that asset will also depend on other competing push for that capacity. Yeah?
Understood. Thank you so much. All the best.
Thank you.
The next question is from the line of Ankur Periwal from Axis Capital. Please go ahead.
Yeah, hi sir. Thanks for the opportunity. First question on, the customer feedback and your, comment on the overall order book, especially for the specialty chemical business. This order book visibility, which is both from Q3, Q4 as well as for the next financial year, is it largely led by the new products that we were doing with the global innovators, or the older product portfolio and seeing some recovery in terms of demand there?
So Ankur, this is basically a mix of both. And rather, I will say, the old molecules as well as, means we are talking of, all three old molecules, order visibility is there. Rather, it is better, than, what we have seen, in the current financial year. And, it is reciprocated, in the orders or, in the contracts also. So it is basically what we are talking is, you can say 50% blend, between the new products, which, we have launched, in last 6 to 8 months, plus, what, we are talking about this 30 crore project, plus, the traditional molecules for which, we have already the capacities in hand.
I think the thing to bear in mind there, Ankur, is also a fact that we've said about the Dahej assets, which you should think of, about, so this includes both Surat and Dahej, but specifically for Dahej, you should think of the MPP and the dedicated agro. And in both those cases, you have the power numbers, right, already with you. So when we are talking of a strong order book, we are virtually saying of how much increase and, good utilization of that capacity will start to come through. So it's a combination of everything.
Sure, Anish. That's helpful there. Second bit on the CDMO demand, which you had highlighted. So if I just clarifying there, while the phase 1 of the new CGMP4 will be dedicated for the earlier contract that we have, in between the new products that we launched, it will be more on campaign based. In the longer term, these products will get probably used or will be getting manufactured in CGMP phase 4, CGMP4 phase 2.
So it's a bit premature on where they will eventually scale up, but as you know, the pipeline for registration of projects, etc., is quite elongated in this business, right? So where we are doing is these are late-stage molecules, they are still in study phase, and the idea is to continuously build our pipeline. So while we are growing and deepening our relationship with European CDMO, some of these promising molecules also we hope, and this is just, at this stage all I can say, how the risk profile in that business is, right? So the idea here is that one of these will come in, and like we've talked at the site visit also, the fact that these are late stage and they are all innovator, they are all blockbusters. So not necessarily all will come. One could come, not necessarily even one could come. We don't know that yet today. But the idea is that it does take time for them to get to the scale-up position, And if you remember, even for the European CDMO molecule, we had said that the work actually on that had started 2 years ago, if you remember. So there is enough sort of headroom available for us to continue doing what we are doing in the capacities we have. 1, 2, and 3 is also a good size capacity. The potential for that is also quite good. Phase 1, when we say dedicated, we think we are actually dedicating in terms of allocating it to Fermion. And, and then phase 2 comes in when some of these mature, yeah?
Sure, Anish. And just last one, if I may. We did mention our focus to gain volume, bring in efficiencies, and sort of, scale up the capacity utilization across all plants. And at the same time, our guidance on the margins front, or let's say directionally, we are looking at a 25% sort of a margin outlook. Will this, the bridge over here, will it largely be because of the shift in product mix, revenue mix more skewed towards specialty and CDMO, or there is some bit of pricing element uptake as well that we are, building in our broad assumptions?
It's a basket of things. See where we are. We had said that, if you remember when we had hit, I think it was Q3 of last year when we did the 15% margin. We had talked of our journey from 15 to 20, 20 to 25. I think we are well on track on that journey, and it will slowly and progressively get to that target number. Our intent is to get there in a sustainable manner. That's the main thing.
Sure. That's helpful. Thank you and all the best.
Thanks.
The next question is from the line of Anubhav Sahu from Macpro Research. Please go ahead.
Hello. Thanks for the opportunity. I have a couple of questions. One is on European CDMO agreement, which is, I remember back, it's a 3-year supply agreement starting from calendar year 25, which you also have mentioned that from Q4 24 we would be starting supply of 2 intermediates. So these 2 intermediates which you mentioned, are they the additional ones than the original 3 molecules we talked about? So does it change in terms of the number of molecules which we are catering to this client?
So these two new ones are actually 2 new molecules, as the name suggests, so that's what we intend to say. You're right on that. And the 3-year agreement is renewable automatically. So, you, as we've said before, that this particular end stage molecule, that the drug that will come, is patented all the way in most geographies till 2035 and beyond.
Okay. Second part for this is the timeline of supplies. Though you kind of took this question earlier, but still just trying to understand that because they would be a dedicated facility, CDMP, for this client. So is the supply is going to be more back-ended in some way? How do you see this?
So remember, when I said dedicated facility, we call it dedicated because in our capacity allocation, we are taking that particular capacity is required for something like this at its peak, right? Before that, of course, the plants are fungible. We have got capability and flexibility to deliver that growth as it progresses to that peak, even from 1, 2, and 3. So the sales will start. In fact, the sales have already been there. I think someone on the call before referred to the supplies domestically for the same molecule, right? So that is already in the process. It's not like we've not done the dispatches under that contract.
Okay. But the commercial one will start from Q4. This is what you mentioned.
Sorry.
The commercial supplies will start from Q4. Is that the case?
No, the commercial supply for the European CDMO MSA is already started. Okay, it's already started. We have now firmer order positions, which I'm saying will show you the growth in Q4 and in the coming quarters.
Okay. My last question is on the, I'm just trying to understand the demand supply dynamics in specialty. Just trying to have a perspective from you that which is the bigger factor, whether it is a moderation in demand or, China dumping in other regions, or is there still a case for channel inventory rationalization? Which of these 3, which is the more concern factor for us right now?
Okay, so I think again, channel inventory in our view is like a dead horse. Yeah, there's too much beating going on that. I think we have to recognize the fact that, and as we've said this before, that this market means that in a strategic relationship, you have to work closely with your partners. We were early to recognize that, and we have played that to our strength. So as we've talked and established our equations with the customers, we have agreed that, we will remain part of their supply chain, work with them on delivering the products, and like I said, there will be a reduction in pricing, but the absolute EBITDA will be protected or increased because we've now got higher capacities that we are committing to them.
Okay, understood. Yeah. Thanks a lot.
Thank you. Ladies and gentlemen, in order to ensure that the management is able to answer questions from all participants in the conference room, please limit your questions to 2 per participant. The next question is from the line of Dhara from ValueQuest. Please go ahead.
Thank you for taking my question. I hope I'm audible.
Yes. Yeah.
So my first question was on the subsidiary. So if I do consol minus standalone, the subsidiary has reported a 15% YOY decline on revenues. This is the subsidiary from where you're doing all the new projects. So if you can help us understand what is driving the 15% degrowth on the top line?
Yeah. So again, on the subsidiary, and this is what I was saying before, the specialty business, we've seen a difficult time, and obviously, Q2 has seen that, not all our capacities are utilized well. But that's exactly what we are talking about, that we were early to recognize that this would be the situation, and we've taken corrective actions which now are giving us line of sight into Q3 and beyond. For higher level of capacity utilization, and the conversation we've just shared, Nitin, myself, and Vishal.
But these are all new projects that we have executed, the 195 crore capex, the dedicated project, the Honeywell project, everything sits here. So if you could specifically call out where the underperformance is?
So Honeywell project, as again we've said, is actually doing quite okay. We've said there's no problem there. The 80% is there. I've talked about the 80% capacity over there, and that's not because where our issues are. Our issues on the plant are fully behind us. We have tested the plant to run at 100 or even higher 100. So we have that in place, right? The Honeywell order book will increase as time goes by. We are already seeing interest rates being softened. The industry on the construction side will boom. This is one of the end users of the product, so that will come in. On the spec chem side, it's market related, the market dynamics, and like I said before, we recognized it and we responded to it to come back out of it and come back out of it strongly.
Sure, thank you. The second question that I have is on the European CDMO contract. Sorry, I'm harping on this question again. But as I understand, the CGMP for the 160 crore capex will take care of the larger ramp-up of this project with European CDMO. But if you have to put a number to FY25 that you'll be doing in your existing CGMP 1, 2, 3, what sort of revenue potential?
I won't put a number to it, but if you look at our, in the CGMP or in this particular business, and when we've talked about the capex, we've talked of peak annual revenues at 2x of capex. So you should look at the peak annual revenue. That will come in over time, yeah? I'm not going to give a guidance of which year and when, but there is a guidance out there of the 100 million by FY27. We stand to it. Yeah?
Okay, sure. Thank you so much. That's it from my side.
Thank you. The next question is from the line of Rohit Nagraj from Centrum Broking. Please go ahead.
Yeah, thanks for the opportunity. So first question is, one of the competitors has announced that they are planning new HFO capacity in India. So what is our dialogue with Honeywell? As I think earlier we were contemplating of debottlenecking the capacity and maybe subsequently doubling the capacity, for which we have kept the space at the Dahej. So what is the current status and what would be the roadmap for the same? Thank you.
So Rohit, again, I will not be able to talk of the rationale of what the competitor may have announced. All I can tell you is that our conversations with Honeywell, with like any other strategic customers, are continuing, ongoing, and there is always opportunities that we are exploring to deepen. But, at this stage, I can't talk about the debottlenecking or anything, because as these projects will come up, we will sort of, discuss with the customer and also, once the internal commercials, etc. are clear, then we talk about it with the board. Once approved, then we come out of it. The other thing to remember also, whether there's new capacity coming in for HFO, the market for this is always going to increase. It's not shrinking. So, there's enough space for everyone in that.
Sure, that's helpful. And second question is, you just mentioned that for the CDMO, we still have the target of $100 million in FY27. So what could be the contours of the same, given that FY25 will be having closer to say 40 plus minus $1 million, and we are contemplating almost 2.5x increase in next 2 years? Thank you.
So, again, I think we've said a lot for you to do the math, because if the first phase of CGMP4 at 160 is going to give you 2x revenue, you know where that is coming from. And obviously, we've had track record of doing the base business at a certain level, And like we said, there were certain molecules that have not come in the past, will come in the future. That optimism and that assurance is still remaining. Simultaneously, Nitin and the team are also working deeply to extend the reach of our relationship with the customers, both new customers and deeper. So there's a combination of things, including the ones that we've shared with you, some of the molecules that we are working on in late stage. Late stage molecules have a risk profile. That risk profile is relatively low compared to early stages, right? So some of them will work. There's a portfolio effect that will play out on all of this.
So this is helpful. Thanks a lot and all the best.
Thank you. The next question is from the line of Reshma Jain from DSP Asset Managers. Please go ahead. Sorry to interrupt, the current participant has been disconnected. We'll move on to the next participant. It's from the line of Keyur Pandya from ICICI Prudential. Please go ahead.
Thank you for the opportunity. 2 questions. First, on the growth side, so FY25, now since this 540 crore project is commissioned with some delay, so the growth in this specialty chemical would be driven by this 190 crore capex MPP. And if that is so, then if you can just talk about number of molecules or what kind of utilization it is working at. And second, is it fair to assume that next year's growth would be largely driven by 2 key segments? One, ramp up of this 540 crore project, and second is CDMO. That is first question.
Sorry, I lost you there. What did you say second was, Keo?
So one is ramp up of this 540 crore project, and second is CDMO. For the next year as a
I don't think that's correct. See, all our verticals, if you look at the growth we've done in HPP and the further growth potential that even exists in the base business, and I'm not even talking about new R32 that's coming in, right? So you've got new R32 that's coming in. You've got AHF that is going to come in next year. So that will also start trickling into the revenue and the growth. So our pillars of growth are very strong in HPP. Spec Chem, I think we've already given you a good purview of what we see in Q3, Q4 and beyond. And CDMO, again, we've given you. So actually the growth will come from all 3 verticals,
Just one follow-up. So on the current project, so the MPP of 190 crore project, how would be the utilization? I think the revenue potential around 270 to 80 crore. If you can just talk about what number of molecules or the revenue run rate that which we are.
So in the MPP plant, particularly around capacity utilization, see, when we last spoke, I said capacity in MPP very difficult to define in tonnage terms. But in terms of value, we've talked about saying that MPP would be somewhere around, we would be in the range of about 70%, 75% in terms of the peak annual revenue. But of course, as we go into the next year and coming year, given the other visibility that we have, we expect that to increase. Plus, we also use the MPP to continuously do new molecules. And part of the reason for doing those new molecules is to actually keep the pipeline strong so that you are able to utilize your own assets and also use that as a decision making if you wanted to make further investments into it.
Noted. Just last question and second question. So on the capex side, capex for FY25 and 26 and the areas of capex. Thank you and all the best.
So the capexes that will continue into 25 and 26 of what I can tell you now are only the board approved projects, which are R32, AHF and the CGMP4, yeah. Those are continuing. Like we said before, there are several projects we are working on in the hopper. Some of that will mature, and we do hope to look at progressing at least one of those options by middle of next year. Middle to late middle, this is just rough indication, yeah. And that's to fuel the growth beyond 27 as we are talking about. Does that help, Keo?
Yes, actually, sir, Kevin has been disconnected. We will move on to the next question. It's from the line of Archit Joshi from B&K Securities. Please go ahead.
Hi, sir. Thanks for the opportunity. I just have one question on CDMO. While we have discussed a lot of permutations around the $100 million target that we have for the business segment, what would be the significance and the roadmap that we expect for the US major and the UK majors that we have been dealing with? How would be the nature of that business? Would it be campaign-based, or do we expect something significant, let's say, in a 2 to 3 year timeline?
It will progress. It's very difficult to give you that timeline, and that's the reason why we work with a hopper of products over there. So it's not just these two, but there are others as well. These two currently look most promising, but again, that's all I can tell you today. But which one, what will come out, very difficult for me to second guess that, Archit.
Sure, sir. But would it be fair to assume that these will be some of the important or, let's say, significant ones while we are considering the $100 million number, given that...
So think of it this way. I mean, I would answer your question in another way. I mean, if you look at FY23, I think our revenues were in the range of about 350 odd crores, right? And that was with neither Fermion nor the European CDMO, nothing, right? So if you just extrapolate that, the potential of the business is there for you. We have reinvigorated the business development teams. There's a lot of direct involvement from Nitin and and the CDMO business leadership in this area. There will be growth. It doesn't have to depend on just one or two of these molecules, if you know what I mean. It depends on the overall macro in the industry, and we know the macro in the industry with the Biosecure Act that there is greater emphasis for the large players to look at optionality other than China, and India tends to be more competitive in that space once you step out of China.
Sure, sir. Got it. Thanks and all the best.
Yeah.
Thank you. In the interest of time, we will take the last question from Nitesh Chu from Dolat Capital. Please go ahead.
Yeah, good evening. Thanks for the opportunity. Sorry if I'm repeating this question, but the CDMO revenue mix has moved significantly in favor of India at 61%. Wherein,
Nitesh, it's sounding all jumbled up. Maybe you'll have to either come closer to the microphone or talk slowly. And loudly.
Sorry, is it any better?
Yeah, better. Just go slow.
Yeah, sure. So I was asking on the CDMO revenue mix that has moved significantly in favor of India at 61%. So while so is it to do with the increase in the late stage molecules, and and this is how it will be going forward?
No, I don't think you should be looking into that. That supply into India is at the behest of a global customer. So that's just being supplied today to India. It may continue to India. The proportion will change, we know for sure. It's also an equation of the registration timelines, and I think we've shared that before as well, Nitesh. I think you were at Devas, right? So,
yeah. Right. So just one more question that's on the finance cost. So what I see is that the net debt has increased by over 20% year on year, but the interest cost has gone down by around 30%.
No, so net, sorry, did you say net debt has increased by 20%?
That's year-on-year. I mean, if I'm looking Q2 to Q2.
Okay. So if I look at March to now, right? If you look at March to now, our debt hasn't increased that much. But, to point you on your finance question, I think I know where you're coming from. You're looking at the interest cost, aren't you?
Yes.
Yeah. So, see, what happens, Nitesh, over there is our project loans that we take, some of these project loans are generic project loans. And in the early stages of the projects, a lot of the allocation happens between the projects and the GST associated with CapEx. But as you know, the GST on CapEx is a working capital item which gets unwound at a later stage. So earlier, the amount of projects, the interest cost that is attributed to the non-fixed asset type expense, but still CapEx in nature, hits the P&L. And now as your spend increases towards the fixed assets itself, that gets allocated to capital. That's the way to think about it. Yeah?
Hello.
So did we lose it?
Hello, Mr. Nitesh. Did this answer your question? Sir, the current participant has been disconnected. As this was the last question, I would like to hand the conference over to the management for their closing comments.
All right. So thank you all for the time today. On behalf of Vishad Bhai, Nitin, and the management of Navin, I would like to wish everybody a very happy Diwali, and also, of course, Payal. Couldn't miss you, Payal. Yeah. So again, happy Diwali to you and your families, and stay connected. Thank you.
Thank you.
On behalf of Navin Flourine International Limited, that concludes this conference. Thank you for joining us, and you may now disconnect your lines. Thank you.